and welcome to another episode of Informed Investor. Over the course of the past few weeks, we've been talking about various asset classes and how to go about investing in them. But perhaps the backbone or the central theme of any investing lies in how you analyze a company or the worth of a particular asset and then reach a logical conclusion. To that regard, balance sheet analysis is something that often goes ignored, especially when you're looking at stocks, but it's something that is perhaps the central driving force of understanding what makes a company tick. Two gentlemen who understand that process very carefully join in to talk about it. Nikhil Vora of IDFC Securities and Bharat Iyer of JP Morgan. Gentlemen, great to have both of you on the show. Nikhil, just to kick it off with a definition first, how would you define what a balance sheet is and what its analysis entails?
Well, frankly, I think the genesis or the core of any investment research really lies in how one really able to understand and analyze balance sheets and make a slightly more informed decision making post that. So I think it's important to really read the numbers beyond what is really being published, be it on the revenue growth of businesses and how that's really getting derived, to what are the salience of certain balance sheet items, be it on the debt part, be it on receivables, and so on. So I think it's important to just judge particular businesses and companies in the context of how their reporting standards are and how transparent and consistent they are in the same as we move forward.
But comment on that and on why it's important, because for a lot of people who analyze stocks, it's the non-sexy item in terms of analyzing a company. It's easier to work with earnings, to work with ratios, and then reach some kind of conclusion.
Well, I guess, while earnings is just one particular number, what you want to see is the key drivers and the key pressure points behind the number. And it's very important to look out for these, because, reporting a set of numbers given some constraints is always easy. But from an analyst perspective, you really want to see what's driving numbers, what's impacting numbers. And I guess for that you need better disclosures, and you want to see the background information behind it. Luckily in India, we have fairly well set accounting standards. Earnings are reported almost 4 times a year, every quarter, and we also have access to balance sheet and cash flow data at least once in a year. So while you prefer balance sheet and cash flow data more often, I guess even the earnings numbers given to us once a quarter are fairly well defined, and we have fairly decent disclosure standards, so that does help.
Nikhil, just to get to the broad heads of a balance sheet that we're looking at, there's assets, liabilities, equity of course, but let's take it with assets. What's the ABC items you would look at while analyzing the asset side of a company?
I think the most critical element of any balance sheet read that one would look at is really to look at the size of the balance sheet first level, and it's important from the construe that one makes about growth of a business, whether the balance sheet size also keeps growing in pace with that, because the revenue generation capability of any business is really dependent on the investments or the asset base that the company really has over a period of time and how they build it up. So I think first level is to really look at how really the overall fixed asset of the business pool really grows, and the second part is to look at the constituent of that fixed asset and how that is really getting financed out, be it through the net worth of the company or through the debt of the business. So I think to me that's the two critical elements to really look out for. And the third part is to look at the receivables in that business, because as we move forward, whether the business growth is being driven by the underlying cash flow generation capability of the company, or is really being funded by pushing the business through a receivable cycle, which can literally lead to a debt trap over a period of time. I think that's really the critical element to look at.
That's an interesting point, Nikhil, and that raises the question of, aside from the size of a balance sheet, does the structure and style of the business matter as well? Because on your point about cash flows, it makes something like a construction company more vulnerable versus another sector, right?
Oh, it does, and I think that's the reason why you also see in a lot of cases how businesses tend to get derated or re-rated based on how the balance sheet is perceived to move today and forward. So a business which which has capability to grow on its own cash flow, which would mean that it's really generating adequate cash reserves and thereby growing on net worth and not really on debt, does tend to get re-rated significantly ahead, rather than a business which is growing on external capital at every stage in their growth path. So I think that's the difference which ideally gets realized very early in life. And you start to look at businesses accordingly, and the fact that, say, a branded business, for instance, will grow significantly on their own cash generation, whereas in a lot of infra businesses that we look at today does grow on external capital, and thereby the re-rates in those businesses do take a lot more time and a lot more persistence than, say, a branded business or a consumer business would do.
Bharat, coming on that point about liabilities, what do you watch for while analyzing the balance sheet of a company in order to understand the liabilities and, more importantly, the size of them and the impact on earnings thereof?
I guess when you're looking at the liabilities, you look at quite a few factors. It's just not the quantum of liabilities. You're looking at the solvency of the company itself, whether it's able to, the sheer size of the liability in relation to the size of the company's operations. You're also looking at the liquidity situation of the company. You're looking at the tenure of the debt in particular, because what you don't want is a mismatch between the borrowing side and the asset side. You don't want long-term borrowings going into short-term assets or vice versa. So you do look at these things. Besides, I think you also look at a few factors like the nature of off-balance sheet items. If the company is indulged in things like sale and lease back, for example, or even the contingent liabilities, they tend to be very, very important because these are very easy to ignore, but they do have a material impact on the company's operations down the line. So it's quite important to take a comprehensive view.
Just to work with comparisons again, Nikhil, why is it that a lot of people also tend to work with the cash flow statement rather than the balance sheet, and what would you draw as the defining line between the two?
See, I think at a lot of points in time, balance sheets are obviously a statement of intent which the business does over a period of time, because a lot of times you do tend to capitalize the businesses ahead of time, and thereby the impacts on cash flows are not as significant in the near term as it ought to be, and thereby the return ratios or return on capital does tend to look significantly lower than adequate or fair return on capital of those businesses, whereas cash flows are more dependent on the profitability or the underlying business merit as of that moment. So to that extent, the near-term visibility of a business is determined by the cash flow generation capability of a business, whereas the longer-term longevity of a business would possibly be driven by how the balance sheet structure is and how capitalization really moves. Both of them are not independent factors, it's interdependent, but I would think that cash flows are something which I would be comfortable if I had to look at the next 2-3 years of a business growth and how the underlying businesses are. Whereas balance sheet would be more dependent about the amount of capitalization and the amount of growth needs for a business, and thereby the longevity of the business over a period of time.
Okay, let's take a break on that note. When we come back, we have just set out the bullet points of analyzing a balance sheet, more details on that analysis, and of course how to break it up in terms of sectors when you are looking at them. Be back.